Sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, fresh economic data is moving the markets and boosting hopes for a June rate cut from the Fed. Investment strategist Greg Peters shares his expectations on what it means for U.S. growth. Then, General Electric was a mess when its CEO took over in 2018, but breaking up the business seems to be the key to the company's newfound success. And later, a shakeup in the obesity drug market as Viking Therapeutics stock doubles on a positive trial. But first, we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Al Root, and Megan Leonard. So, Ben, most of the week was kind of boring in the stock market, but then quietly, the S&P creeped up, hit a new high. The NASDAQ hit its first new high since, I think, 2021.
That's right. And the S&P 500 is now up for 16 of the last 18 weeks.
Wow.
It hasn't happened since 1971, so I wasn't even alive yet. But it was an interesting week because we did get this inflation number from the PCE report that was, it wasn't hot, but it wasn't cool either. And the market seemed to brush that off. The GDP number was revised down a little bit, but not enough to worry people. And it looks like first quarter GDP is running at about 3%. So the economy is doing fine, and we have to see that inflation come in. But right now, people just don't seem worried, and the market just keeps ticking up.
Interesting part of the market is the Russell 2000. We don't talk about it a lot, partly because it's been so awful for so many years, but small caps catching a bid. The equal weighted index doing well. Is this sustainable?
I think it is. I mean, I think what we've seen is that you've had these mega cap stocks and they've done really well. And now people are thinking, you know what, I can take some off the table here. And so you're seeing things like Apple. Apple's not having a good year so far. Google or Alphabet, it's not doing much. But you have other stocks that are starting to get involved in this rally. And I think that's really a good thing for the market, and it's a good thing for investors who are looking for other stuff.
Yeah, much needed. What are you looking at in the week ahead?
Well, we got to talk about Dune, of course. I mean, it says Warner Brothers second, the sequel to the first one. It looks like it's going to be a big hit. The movie theaters need it to be one. But seriously, I think it's going to be the payrolls report. It can't be too hot. That's going to freak out the Fed, and we're going to be watching wages closely. If that comes in hot, that's going to be a problem too.
You also have to keep in mind that this report's really critical, and all of the February reports are going to be critical because we did see a lot of noise in those January reports. So the next round really needs to be a little bit more make it or break it to determine whether January was a one-off or we do have some trends that we really need to keep our eye on.
That Friday morning is always exciting. You mentioned Apple. Al, let's talk about the not going to happen Apple car. I think the most succinct summation of the auto industry's response was 2 emojis in a tweet from Elon Musk.
Yep. I feel somewhat vindicated. It didn't make sense. It never made sense. We've been talking about an Apple car for almost 10 years.
But you said many years ago, this is a crazy idea.
Now, it's obvious why Apple would look at it. Auto's $2 trillion industry. It's a large addressable market, but it's not a very good business. Apple makes 30% operating profit margins. Toyota makes 10%. Tesla last year did 9%. Apple has 25% market share of the phone business. Toyota has 12% of the global car market. It is more competitive, more capital intensive, and more regulated. It's just not a very good business. So now that Apple can focus on things like AI, they said, forget this car.
More good news for Tesla when the Biden administration announced it was looking into Chinese cars as a possible national security risk.
Right. So what this really represents for me is it's another barrier that Chinese automakers will have to hop over to bring their cars to the U.S. There's already a 25% tariff on imports. You really need to build capacity here to sell cars here. So that's a barrier for the Chinese. It takes years to do. And then now Biden is going to look at the national security implications of some of their cars. So it means for Ford and General Motors, they have time. They have time to get ready to compete with the Chinese.
We saw the BYD supercar on the screen there, Al. You're not going to get that now. You have to sell it for a Lamborghini.
The crazy thing about that is if you're an independent company, Ferrari, Porsche, $160 billion market cap. But if you're a mass market automaker that makes expensive cars, Ford, GM, Volkswagen, basically the same market cap. So if you're independent, great. If you're a mass market automaker like BYD that tries it, terrible.
And whether you have a cool car or not, Megan, I've learned that from you that younger people are abandoning dating apps. Well, what are they doing? Going to a bar to meet people or something?
Amazing theory, right? It feels like it worked for our parents and our grandparents. Maybe we might bring that back. But no, seriously, we had Bumble coming up with its earnings earlier this week, and it wasn't a good one for many, many reasons. But there are structural issues that dating apps and places like Match.com and Match Group are actually dealing with at the moment. So we have these issues where, 8 out of 10 college students have no appetite for a dating app, and they're not currently on it. That's a big headwind for these folks. And of course, Bumble did actually come in and they, missed revenue. Their outlook didn't look great. So, a lot of folks are saying, this is not just the issue with Gen Z, but it certainly isn't helping the situation.
Anything these companies can do to find a new line of business or tweak what they're doing?
I think, it was interesting. We actually heard from the new CEO of Bumble. And she was pretty candid for her first, time out with the earnings call. She did say that, not only are we going to have to use some of the traditional metrics, and Bumble is coming out with a new app so that they'll have a nice refresh look, but they're also going to sit there and try organic methods. So, reading between the lines, that means in person. And certainly we sort of see that a lot of folks are actually sort of experimenting with this. We've seen some speed dating events coming up. So if you're in the New York area and you are interested, it does look like it is a possibility.
Organic dating. Sounds good to me. All righty. Meanwhile, organic inflation data coming in at the lowest levels in 3 years, but the days of 0% interest rates are behind us. PGM's Greg Peters will tell us why that might not be such a bad thing next. New economic data out this week giving fresh insight on the health of the economy. The Federal Reserve's favorite inflation gauge coming in at the lowest annual level since March of 2021. Meanwhile, fourth quarter GDP was revised slightly lower, down to 3.2% from the advanced reading of 3.3 last month. My next guest says it's healthy for the economy that the days of 0% interest rates are over. Joining me now is PGIM Fixed Income Co-CIO Greg Peters. Greg, thanks so much for coming by the studio.
Thanks for having me.
We appreciate it. So you were early on the higher for longer train. Wall Street's now come around to that view. But what's interesting is you say it's really better this way. You don't yearn for the days of financial repression.
Yeah, so I think we're coming off of a very unique period that many folks just forgot how it was, right? So typically interest rates are higher because growth is pretty good. And there's a little inflation, right? And so with this massive QE and zero interest rate policy, we kind of perverted the whole kind of investment realm. And so I think we are in a much more normal environment. And then also the reason why we think rates will remain higher, not lower, is simply because inflation, right? Before, central banks had to worry about inflation, or they didn't have to worry about inflation, and now they do.
Sure, and all sorts of weird things happened when money was free, right? You had companies like WeWork going crazy and just bad capital allocation. But one interesting thing now, we also haven't gone back to the days of 1% growth. 3.2%, the most recent print, that was higher than most anybody expected. What's driving that? And we should point out that that is inflation adjusted, right? That's
Correct.
A real GDP number. What's driving it?
Yeah, I think there's several factors. The first is fiscal. So there's been a tremendous amount of fiscal impulse into the system. I think that matters and has mattered a lot. The second is the expansion of the labor force. And what has really caused that to occur has been actually immigration. And so just having a wider swath of workers has been incredibly valuable from economic growth perspective, as well as disinflation as well. So it helps on the margin there. And wage growth. So you're seeing higher wages. I think having a broad swath of workers earning more is better for a more balanced economy. And the last is higher rates on savings, right? I think the additional income that savers are getting matters to the discretionary spending side.
Your first point about more fiscal, is there a danger that's kind of unsustainable? I mean, the government just spending money to drive the economy, but that can't go on forever. Is that like a sugar high that will come down hard from?
Well, it's going to be a long sugar high because we don't see that changing anytime soon, right?
Okay.
So I think the fiscal deficit is here to stay. I think if there's one thing both sides of the aisle can agree on, it's spending or not cutting at least. So I think this is the world that we're in. But of all the things I worry about, particularly in the U.S., the fiscal deficit is not one of them.
Alrighty, well, someday that's going to be a problem.
Someday, yeah.
I would follow up on that, but real quick on immigration. Obviously, we know half the country has had a big problem with immigration. Now the other half has a big problem with that. I mean, both Biden and Trump in Texas this past week. Do you think from an economic standpoint we actually shouldn't be as worried about securing the border?
Yeah, so I think there's two separate issues, of course, right? So there's the political side, which I'm not touching, but from the economic side, it's just math, right? So just having more workers to prosecute labor is incredibly helpful, right? And so what has helped the U.S. over the past decade or so, particularly when you look versus Japan, you look versus Europe, has been immigration, right? Because the shrinking populations is a tax on those economies, right? It pulls down growth. So the fact that the U.S. has had immigration that entire time has really helped out, and it helped in the numbers last year, and it looks like it's going to help this year as well.
We're just about out of time, but you are a fixed income expert. You like corporate bonds the best in terms of the fixed income realm. Why?
Well, the supply-demand dynamics are just really quite remarkable. You're looking at a real shrinkage of supply on a net basis in the back half of this year, and it's higher quality. So you're not have to worry about the credit component as much as you do in high-yield bonds and other types of things. So we think risk-adjusted, it's really good.
But you get a little bit more than you get from treasuries.
You get a little
Still
more.
Pretty safe.
Absolutely right.
Greg Peters, thanks so much. Appreciate it.
Thanks, Jed.
GE is getting a makeover. We'll look at how the breakup of the company could be an investing opportunity next. General Electric was sputtering when Larry Culp took over in 2018. Since then, Culp has been moving aggressively to sell business lines and slash debt, and the stock has doubled during his tenure. A big step in the company's revamp comes next month when GE separates its two remaining businesses, aerospace and power. It's the cover story in Barron's this week by our very own Al Root. So, Al, let's get one thing out of the way first. You can get a GE light bulb, you can get a GE fridge. It's not actually GE.
No, it's not. Lighting was sold, the last bit of lighting was sold in 2020. They sold the appliances and toaster ovens to a Chinese company in 2016. So now it is aircraft engines, power generation equipment, and then GE Healthcare, which was spun off, MRI, CT scanners, all that medical stuff that takes our pictures.
So at what point GE was the most valuable company in the country? Obviously, very rough period there. Now the stock is back to 1998 levels, but it's a great turnaround by Culp. How do you do it?
I think two things, right? I think there was an acute phase and then sort of a strategic planning phase. When he got there in 2018, too much debt, deteriorating cash flow, things were bad. And he took his medicine. First month, he officially was CEO, slashed the dividend to $0.01 a share. And started selling assets, said, we got to fix this balance sheet no matter what. So acting fast and sort of admitting the state that GE was in, and you know, interestingly, he's the first outside CEO from the company, so he sort of didn't have some of that legacy baggage maybe of the other managers. So that's what he did. And then after things started to stabilize, the patient was stable, he said, you know what, the best thing is we're going to split this thing up. So having that vision, but really taking that medicine, I think was very important.
He's not too bombastic. He's kind of the anti-Jack Welch.
I think that's fair. And I don't necessarily think we need to denigrate Jack's performance, but, you know, he wrote books, was always on CNBC. Neutron Jack was his nickname because of, you know, his what he would do sometimes to cut costs and sort of be aggressive. Larry cuts cost and does that thing. I would characterize that as more soft-spoken. So he's very different. He is the anti-Jack, but I suppose that just shows that there are multiple ways to make this thing work.
Sure.
So, Al, I have to ask, if I own this stock, do I hold it into the split? If I don't own it, do I want to think about buying it?
So I think that if it were me and our recommendation, buy GE and just hold it. Check it in a year. You'll have 2 shares instead of 1 share. But the value of your holdings will increase over the next year. GE Aerospace, the challenge with GE Aerospace is trying to get to find someone on Wall Street to say a bad word about it. Dominant producer of aircraft engines, 75% market share in commercial aircraft, lots of defense engines as well, good margins, super stable business. That one's going to be led by Larry. Vernova, which is this power business, gas turbines, windmills, electrification, things for utilities in the grid, that's a turnaround. They've had weaker margins, some money-losing businesses. They have to improve that. But I think just keep it simple and hold GE.
But to Ben's point, what about the company that is already spun off? So what about healthcare? Is that a buy-sell play?
Well, I think we picked it in March 2023. I still think it's a buy. It trades at about 21 times earnings, which is a discount to some of its peers, which tend to trade at 23 times earnings. Now, why do you like this? So it's an independent company now. They improved margins in year one. More R&D investment. Wall Street expects them to continue to improve margins. So it's kind of like in the early stages of its life as an independent company. So I like all three GEs.
And we should say it's MRIs, CAT scans, that kind of machine.
Ultrasounds, that's what, in software associated with all that stuff, that's what GE does. Healthcare.
Okay, but they seem to have actually done pretty well with the spinoff. So then is this a playbook for others to kind of follow?
I mean, I think sometimes these things are cyclical, right? Sometimes we love conglomerates because they're diversified, and then sometimes, it's not working, so we'll split them up and we'll be focused. I do think that I do like this idea. I sort of identify this of focus and building up a business, spinning it out. I do think it's a good play. Danaher does this all the time. 3M is going to spin out its healthcare business. So I do like this sort of as a strategy. Keeps bankers employed, of course.
Yeah, exactly. Well, 10 years from now, they'll put it all back together, right, and make the fees. So can I buy a company that just does Post-it notes?
No. Oh. So only the healthcare portion of 3M is going. And that's sort of a capital raising event because they face a lot of liabilities associated with some earplugs and some water pollution. So that the 3M is lost about 55% of its value of the stock over the last 5 years amidst all this turmoil. So while the healthcare spin, which will be named Solventum, which is there you go. Okay. Solventum, that might be worth a look, but 3M still faces so much uncertainty, it's tough to recommend that one.
Hope it solves their problems. Alrighty. Al and Megan have a pair of investment ideas to boost your bottom line. And Ben says one healthcare company has emerged as a competitor to the big name obesity drug makers. Stay right there. So, Ben, investors in Eli Lilly, Novo Nordisk got a little concerned this week. Investors got their appetite back for the shares, but there's a new player in town in the obesity drug market.
There is. It's called Viking Therapeutics, and it released some data that showed that it has an obesity drug like Ozempic, or I'm not even going to try to get the other names right. Wegovy, that looks like it may be working, and it more than doubled when this release came out. And you did see a bit of a pullback in Eli Lilly and Novo Nordisk. These are a big deal right now. They're really the AI of the healthcare world. With Eli Lilly probably sharing the role of NVIDIA with Novo Nordisk. But right now we're in this phase where all these companies, you could show that you have something that works and you're getting a big bump. But at some point there's going to be competition that isn't there right now, and that could be a problem for some of these stocks. Eli Lilly, for instance, it's gained about 150% over the last 12 months. Trades at 55 times earnings. It needs to have a moat to be able to hold off this competition. Right now, that might only be manufacturing, but it's going to be interesting to see what happens here with these drugs.
I like your AI analogy. That's interesting. So all this excitement, and there is a lot of excitement. I think these drugs might be good for other things, right. But at some point, they get fully priced. All that good news gets fully priced into the shares. Are we there yet?
I think we're getting close. I mean, 55 is really high, especially for a pharma stock. You look at the competitors, and they're far lower. And I think you see more of these, and you see maybe something like a Viking Therapeutic get purchased by a larger competitor who has manufacturing capacity, and all of a sudden people will start thinking, how much of this market is Eli Lilly going to own?
Got it. All right, let's go to actionable ideas. Megan, April 15 is not that far away. You've got some advice as we sit down and have that awful tax preparation project one of these weekends.
I am in the midst of it myself, so I understand the fear here. But I think the big thing right now is, when you're going through everything, it's worth running the numbers. So before you just simply default to the standard deduction, maybe run some numbers and see, especially if you've had a lot of medical expenses over the last year. So, you can deduct qualifying medical expenses if they exceed 7.5% of your adjusted gross income. Now, that sounds like a lot, but those things do add up, all those MRI scans. And so you can sit there, and that includes things like nursing home cost and other care facilities. It also keeps, your long-term premium health care, things of that nature. So lots there, lots to go through. Run the numbers.
Good advice. Thank you. Al, you're going brown for your idea.
Andrew Barry picks UPS for the magazine. I agree with him. At earnings turnaround, it's a good entry point. UPS. What can Brown do for your portfolio?
Oh, nice. Thank you, Al. Thank you, Megan. Thank you, Ben. All great ideas. To read more, check out this week's edition at barrons.com. Don't forget to follow us on X at Barrons Online. And that's all for us. We'll see you next week on Barron's Roundtable.